Hi, good morning. I think we're good to begin. And I remember, last July itself, we started this particular sessions. And over the last 1 year, I think, thanks to everyone who's all on this call and across the time who supported us, we've moved ahead in terms of a community in a world where it's much more difficult to kind of, just watch a whole movie itself in one go. Staying invested in themes over months altogether is a very different feeling, and that's the world that we are in. Um, it's been also a pleasure for me. It's been and the team. We continuously kind of keep learning from everyone who's again on this call and others who have joined us across this whole journey. In a world where I think more than knowledge, curiosity is required. We kind of have been able to build a great community in terms of understanding and in terms of moving ahead in the investing market. With this, I have a good pleasure of introducing and presenting you our mid-year outlook. Just very quickly before we begin and go there, I'll just quickly tell you about what we did in the annual outlook, where we thought that we were at that point of time, the inflation in India was quite benign. It was around 0.7 odd%. We were running fast. We were at almost 7 to 8% GDP. So the base case at that point of time made sense to be in something which is called a Goldilocks scenario. Goldilocks is like everything's all right. There's no inflation. There is high growth. That's the place that you want to be. Things have moved on from there on, and if you've been continuous on this journey, you would realize that after what happened in March, the geopolitical tension, what we moved was in a world which has eventually become a little more expensive. So with that, let me kind of present to you today's the mid-year outlook that we've got. Yeah, just a standard disclaimer that all of this is for education purposes. Investments and security markets are subject to market risk. Third, again, if we kind of show you any security, any stock that we kind of discuss here is again for education. So with that, what we are naming this mid-year outlook is basically where the herd won't graze. Now, this sentence itself comes from a very astute investor, hardly known, but a really great guy called Ralph Wanger. Ralph Wanger wrote a book, again, very difficult to find on public and on Amazon. You would probably find an old version of the book. It's called Zebra in Lion's Country. So the idea of that entire thing is that, zebras are very interesting animals. When they are always under attack from lions, and they kind of graze the grass which is there in the forest. Now, there are two ways to graze the grass for a zebra. When you are in a pack, either you be on the outside of the pack or you be in the center of the pack. There are two things which you have to kind of here balance out, and this will be very interesting for the investing community. If you're in the center of the pack, the chances of being attacked by the lion is very low, right? So your risk is lower, but what you would be eating onto the grass would not be very fresh, right? Because already somebody's walked on it, or it's stomped out, it's dried out. It's very difficult to get the grass. So the returns are lower, but the chances of being attacked by the lion is also lower. If you're on the outside of the pack, right? If you're on the outside of the pack, then what happens is that the chances of getting fresh grass is higher. The returns are higher, but the risk of being attacked by a lion is also higher, right? So that's the whole pack. Now, the idea is that there is a particular state here, and which is that there's a particular market which is the fastest growing market in the world, right? The highest GDP, and nobody wants to graze it. So if there is an open patch of land where there is not a single there's not a single zebra out there, why not start exploring it, right? Because the chances of the lion attacking as well is slightly lower, and the lions won't attack because they won't have kind of enough people to kind of attack onto. So it's a very thinly interesting place to be. So this is the whole idea, that in this mid-year outlook, I want to be in a place where the herd won't graze. This is a world that has bought soft landing. This is a place this is a world that has invested for soft landing. What does soft landing mean? They're thinking everything will be fine tomorrow. There will be no inflation. We'll kind of sail through, and they are kind of selling they are selling particular securities which are available at very interesting prices. I would rather own them rather than chase another kind of a pasture where there is a lot of herd and the chances of a lion attack is much higher, right? So very quickly, what happened across the last 5 years? Whatever we've gone through, we've gone through a very tough 20 odd months now. Despite all of this, the Indian mid caps is like kind of the best place or the best returns that they've given over the last 5 years. And that is where we've kind of stayed ourselves. Over the last 1 month or we've seen that US has gone through some bit of correction and we're coming back. Emerging markets are kind of coming back. If you've followed us across this particular year, we have always been wanting to place ourselves in emerging market. That thesis starts to play out a little bit right now. And we will come to that. Across obviously this whole year, US has been on a tear on back of the whole chasing of AI names, and for that even China has suffered some another interesting emerging market where we've been overweight that has kind of not been able to deliver returns. India obviously has been kind of at a lower place. Now where we are in macros basically across time or across right now. When we started off the year, the inflation everywhere was kind of low. At this point of time, there is just one place which is in sync, which is that inflationary world. So if you've realized that since the war, we've kind of switched gears and said that the disinflation trade is over. The place where inflation will be lower is now ending, and chances of higher inflation are much higher. So you've got to place your portfolios in a world which is kind of rising in terms of inflation. So inflation is no longer kind of just one region's problem. It is the whole world's problem altogether at one go. And that's what kind of should keep things like that. That's the only thing that should drive a particular portfolio. In our opinion, that's the only thing kind of one should drive through. The other parameters, the forward-looking indicators like PMI, those tell you that where you should place yourself because probably growth would come around. So in terms of PMI, India continues to be much ahead of other players. Second best probably is China, which is at 54 and holding there, and US is coming through. So it's a world where the purchasing managers are placing orders. That means that inflation will continue to stick around. But along with that, you could see a prop up in GDP as well. And that's what we're kind of ending up seeing as well. World across, which was at lower GDP, they've started kind of going up. However, US, this up move in US is from again a low base. It's come down from 4% odd. India has continued to stay between the 7 to 8% region. We started out this year on the left-hand side, so Jan 2026 is where we were at the beginning of the year. June 2026 is where we are at this particular point of time, right? One major change that has happened, and this is a very interesting story. Generally, it doesn't happen, and the reason why it has happened is also again very interesting. We don't agree with it, but this is from Fidelity, so it is something that we want to come out with as well. What has happened is that at the beginning of the year, US was in a late expansionary phase. So this is a late cycle. You're moving into a contraction and possible recession. So US was here, right? Right now, US has shifted back into a mid expansionary place. This is something, generally this is a sign, this moves as a sine wave. You continue a journey forward. It's generally not easy to push back yourself onto the curve, and US has been able to do this. Now, this is a very interesting thing, that how have they been able to do this? And it will surprise you a lot. This happened possibly because they entered into a conflict and are able to print a large number of money to protect or to be able to fund the particular war. Now, when you start printing money, when you start bringing in liquidity just does not go through a particular cause. It goes through a number of other sectors in the country as well. But liquidity has its own risk as well. So what risk does that bring into? It brings into higher inflation. And along with that, US is stuck with an unemployment problem. It has continued to be 4.3. It's not that, even with higher job openings, jobs have gotten placed into. So we are at the country is going through an unemployment problem. The Fed is on hold, as we saw in the last FOMC as well. 9 out of 19 members, I think, have said that they would want, they are looking at a higher rate by the end of this year. So with that, and the major reason why their market is doing well is because of your AI and the hyperscaler theme. And we come to this as well, that their cash flows are not coming in. While earning is visible in almost all companies, free cash flow is not kind of visible. So all of this tells us that probably this shift back, which is very difficult to do in a normal world, the shift back is very temporary, and probably we could within a quarter or two, US could jump back again here. So with that, that is where we kind of placing ourselves. We calling this as a late cycle kind of an expanded. So based on this, US for us continues to remain in late cycle. India remains in mid cycle, and the stance on India is constructive. However, there's a change in what we started. We believed at the beginning of the year. We changed that in April itself. We turned ourselves in April after the war. We began the year with Goldilocks, the scenario where everything is fine, everything is like rosy and all, low inflation, high GDP. That we had placed it at 43%, and a scenario where inflation would be at 40%. We could have beginning or later in the last year itself, we started talking about inflation being higher. Those who've heard us number of times as well, we kept on talking about inflation. The reason being that metal shortages and other commodity shortages across time do not get solved in one go. And for that, we almost kept it at a coin flip that maybe we could end up seeing inflation. And it was very easy as well at the beginning of the year to keep inflation at 40% a probability. Not inflation at 40%, but inflation coming back at 40% probability. It was easy because at that point of time, inflation was 0.7%. With commodities being in shortages, with GDP running hot at around 7-8%, inflation at 0.7% made very little sense to us, and hence we almost kept it at a near even kind of a 43-40%. Now that we've started seeing that we've started having problems in oil as well. We've moved the inflation up, or the reflation in scenario. What is reflation? Reflation is that your GDP is also higher and your inflation is also higher. That scenario has moved up from 40% to 52%. That's the probability that we are putting at, and that means that the early Goldilocks scenario where inflation would remain lower but GDP would remain higher, that has come down from 43% to 30% for us. So we don't believe that there will be a break in inflation as going forward. With this particular scenario, with a near even scenario, we placed ourselves in certain sectors, metals and mining being the most prominent and the most favorite call. I think everyone in the questions as well, we keep on seeing about questions about metals as well. So that is continuing to play on. We started out the year, it did go up. It's taking a breather right now, and we continue to hold it as well. So we continue our overweight stance in that. Along with that, we had already added energy at the beginning of the year as well. We knew that if commodities go up, and this is when we learned previous commodity cycles, if commodity has started going up, oil was lagging behind, and that meant that oil had to come up. We never knew the reason why it would come up, but it's just that when you study the previous cycles, oil was looking like something that would come up. So that for that we had placed ourselves into drillers and explorers of oil. That has also started to play out, and along with that, the conversation that we are having right now is in basically the power grid sectors as well. We believe that given the capacity and given that demand, the supply is not there yet. So it's an expansionary kind of a supply zone created. And when you add supply lanes, it is inflationary. and it is beneficial to a number of players. Uh, this has been our, we've continued with this, and it continues to do similar things as well. So back in 2022, you had, so generally what happens is that when real rates, when you compare inverted real rates, what are real rates? Real rates are your nominal rates minus your inflation. So nominal rates is what actually you see whenever you open up, you see 7% odd, let's say India 10-year, or 4.5% US 10-year. That's your nominal rate. When you subtract inflation, you get the real rate. That is the money that is growing for you. If you, let's imagine if you kept money in your FD and it paid you 8%, but inflation in the market was around 5%. A item like a bread costing like 100 rupees today, if it cost you 105 rupees next year, then the 100 rupees saved in the FD, which would grow to, let's say at 8%, it would grow to 108. You only earned 3%, because now that particular item or like bread cost you 105. So what you earned is basically 3%. So the real rate is much, whenever inflation is positive, which is most of the time, your real rate is lower than your nominal rate. Now, when you invert this, when you plot this in real rate and you invert the chart and you plot gold along with it, gold is something that is supposed to, is the idea of gold is basically the store of value. So gold is supposed to track the inverted real rate curve. This particular kind of this particular correlation, if you say, was broken in 2022, and gold started its up move post that. Even though real interest rates started falling down, gold continued its up move. What this tells us that a lot of belief in the US treasuries is going away from the world, and people are finding themselves much safer in an asset like gold. What we believe is that this is not a blip. A 4-year sustenance of a breaking of correlation cannot be a blip. It is a structural change that has come across. There is definite reasons to not believe in US treasuries, a country with, I don't know the latest figure, but somewhere around 38, 39 trillion of debt. Now it's just a number, right? It doesn't matter that you have 38 trillion of debt or if you have 50 trillion of debt. It is a debt which is very difficult to pay back with GDP. So people are losing interest in particular, or safety, that net in US treasuries, and moving to safer assets, and they believe gold is a safer asset. So the similar scenario happened back in 1970s as well, and we believe that we are in mid to late 1970s and a very similar cycle going through. So if someone is interested, do go read on the what happened between let's say post 1976, 77. This we think that we are in a world very similar to that stage. Another question that we kind of keep getting is that is AI a bubble, and whether we believe that US market should fall or something like that. We've got a major question on that and an entire whole section to figure that out. Just when we look at different cycles as well, we believe that the capex right now being done in AI is in a building stage. We're not there. When does a bubble break? Is when you build enough and it becomes productive, and then eventually you have this major layoffs in jobs, and it is able to bring down your inflation. So we're not there yet. We are in a very building stage of AI. Is it a bubble? Depends on how you want to see it and what time frame you want to see it in. If you're seeing it from a very short-term time period, then it's very difficult to say whether the markets would correct, let's say, by 10% or 20%. But if you're seeing it from a longer-term perspective, let's say a 3-year time period or a 4-year time period, then we are in that building stage and it should continue to do well. What we did was that we overlaid this current AI scenario with the favorite comparison is basically the 2000 .com rally. So what we did was we took the 1990s 2000 .com rally. We plotted Nasdaq here, and this is starting the day Netscape kind of, which was a major thing that time. We started on the date when Netscape was released, and we've plotted kind of how Nasdaq had done in that 1990s to 2000 .com rally. And on that, we overlaid basically the recent rally, and we started with the day ChatGPT was released. And when you look at this, it kind of it's kind of matching out. Obviously, it cannot be tick to tick, but the cycle is kind of playing out in a very similar way. If and only if this is the same cycle, then we are probably in the 1997 era and not 1999 era, which a number of people have concerns with. So this particular build has legs. Obviously, when you look at this particular technology, it's not comparable. It's a little lesser comparable than what we did in the 1999s and 2000, 1990s and 2000. It looks like a faster build, but if you've lived through 1990s and 2000, then you would realize that there were .com companies coming out every other day, not just one, multiple .com companies being released every day. Things which had probably no value as well. You would see them come out every single day. We've not reached that kind of a hype cycle right now. We believe that there is more to come, and the build is kind of there. Why do we also don't believe that we are now at the stage where it should fall off? Is because that a number of companies have raised their capex guidance. They are gonna spend more to build more, which is generally the build case, which leads to oversupply. So people are building right now. So the capex guidance has lifted almost 5 times. Data center construction has quadrupled since 2022. And we believe that we are still ahead in that, like we still have a long runway in the adoption scheme. It's a very interesting thing that whenever you go for this is a very interesting phenomenon which people say in investment, that whenever you go to get a haircut and if the person tells you that this is the theme that you want to invest in, your hairdresser tells you that this is the theme that needs to be invested into, that is the time you know that a bubble has formed. I would be very interested to go and sit in a salon and the person tells me that this is an AI that we have. This is how a haircut would look on your thing, and you know that's like the time that probably we have hit the peak. I don't think we are there yet, so we're still building onto it. So that's our thing on AI. Within this 1 year, we believe that going forward there will be 2 phases into it. The phase 1 is where your war premium kind of unwinds. So the very first phase, which is now to very few months later, this is where your war premium that has happened. So basically, this we are kind of seeing right now as well. Oil has ticked off from its highs, gold has ticked off from its highs. So the war premium starts to unwind. This is a stage where disinflation or lower inflation starts coming into picture, and that is what a number of people have started investing into. We don't believe that's structural. Because that moves to a phase 2 where continuous build in different themes will basically in different themes like data center and AI would lead to higher inflation. So while your war premium may come down, your build will reassert itself and your inflation will start ticking up. So for a small bit of time, your inflation could dip a bit, and beyond that, you could start seeing higher inflation as well. So that's the 2 phases that we are holding on to. On that term, that we don't think central banks have got the leeway to kind of cut rates going forward. They may hold or they may hike. We believe that probably later this year or beginning next year, which when your rate hikes could kind of come into picture as well. The WPI as well, we've also said that the WPI, if you look at the last reading itself, it was at 9.5%. So WPI at 9.5% would trickle down into CPI. That would probably keep RBI interested into a hold or a hike scenario, not a rate cut scenario. Obviously, two ways how this whole thing kind of beats it. The very case for disinflation is that AI lifts up your productivity and it cools your prices. We don't think we are at a stage where it is starting to raise productivity, but it's not at a stage where the entire build is done and hence your disinflation starts to take place. The other common way is that you have China always exporting deflation. They generally have the idea of pushing out materials into different countries and reducing inflation. Uh, that's the case for disinflation. We are waiting on it. We think that China can deflate a number of goods, number of metals, but they cannot deflate oil. And in that scenario, oil would probably keep picking the inflation up. And the case for disinflation is that we are not done with we're still in the build event, and we have not completed that build, and hence your inflation starts keeping going up. Uh, this is basically a precursor. So this is something. What we've done is that we've taken 3-month oil averages and we've looked at inflation in US, a 3-month average. Whenever kind of oil has popped up, inflation has followed. Whenever oil has popped up, inflation has followed. And if oil kind of continues to remain in these kind of ranges, if it there are different scenarios in which oil has continued to move higher. In that cases, if you look at these gray bars in the back, inflation kind of shoots up as well. So that's the stage probably we could enter into, wherein oil here has popped up, and if it continues to remain in this higher range, then you could see higher gray bars as well in the back end. Inflation, what this is something new that we've done this time around. All the while that we've been talking about 1970s and the 1970s script, we've been talking about gold. What we did was that if gold was doing something, let's just and we moved into this regime where we thought higher inflations are coming, then why not just look at inflation as well in 1970? So this is what the team thought it was an interesting idea. Let's go ahead and do this, and this is how it has plotted through. So the gray line here is the 1970s inflation, and the orange line here is basically your inflation in 2020. So when we plotted this, I think it kind of ticks out that it cannot match again tick to tick. But if this is playing out, then we are looking at higher inflations later this decade. It should not happen tomorrow, but probably a year and a half down the line, we should be at a place of a higher inflation. Whenever inflation goes up, again, the concern is that how is inflation kind of good for equities? Because it's natural that if inflation comes in, then your central banks will kind of raise their rates, and it's not good for equities. The problem with this, or the solution to this particular problem, is that inflation, first and foremost, inflation coming from wholesale price index to consumer price index has its own lag. It takes around 2 to 3 to 4 months from there to switch to CPI. Within that period, what happens generally is that WPI starts showing, because the first move is generally a explosive move, like a 9.5% read. The second move itself will be a little lower. It should be around 6% or 7%. We don't know the exact numbers, but when it comes, we'll know that. So the second move will be slightly on the downside. So what this does is it keeps the central bank guessing. And the general idea is that the central bank kind of ends up thinking that inflation is transitory at this point of time. Maybe wholesale is coming down, and so right now wholesale is going up and your CPI is staying there. When this wholesale price gets into your CPI will start trending up and your wholesale will start trending down. And that keeps the central bank guessing as to the inflation is transitory. And then there's a pop up in WPI, which kind of leads to central banks shifting rates higher. So we figured out that there is a 9 to 15 month window in which there's a lag from central banks and inflation is kind of doing its thing, and that is very beneficial for equity. So we'll be riding into that window right now, and it gives you a 9 to 15 month window in which we are very positive on equities. Again, a number of questions around whether commodities are done with their run. If you actually look at commodities, this is the 2000. So what we've done is basically we've taken the ratio of commodities to equities. So DBC is basically your commodity index, SPX is your S&P index, S&P 500, and we've taken the ratio of this as your 2008 high of the ratio. That means commodities were this expensive as when compared to equities. We're here now, so we don't think that commodities are any way expensive. They're very cheap right now. And with that, I think whenever commodities have started to run up, you see commodities turning up now. So this is a zoomed in chart of this particular region. This particular up move is this one, and this higher one is this one here. So whenever kind of commodities, yeah, so whenever commodities have this run up, right, there are three particular regions that you can see here. One, two, and now the third one. Whenever commodities have run up, inflation, this orange line is inflation. Inflation kind of starts coming up after a few months. So if this run up has happened, we believe that inflation should kind of start following. The interesting part about this is that the floor for inflation is kind of going up. Inflation was at a much lower floor. Now inflation is at a much higher floor. That means that it would start becoming much more painful into a very expensive world. Yeah, so it would become a very expensive world, and in that regard, we find India to be cheaper than its 10-year average in when you look at equity valuations. US equity valuations forward PEs on a 10-year basis is around 19x times. They're trading at 20x. Our 10-year average of forward PE is 18.6x. We're trading at 17.7x. So we find India to be cheaper at this point of time and a much easier bet to kind of take in a very expensive world. With that, our positioning hasn't changed in terms of we remain overweight in India and China. We remain neutral on US, underweight on Europe, Japan, and overweight on your bullions and precious metals. In sectors, we are overweight energy, metals, land, like basically the ones that build the nation. We are overweight there. With that, you continue to hear us talking about majorly moving into the power power sector. So basically, right now, your portfolios, if you are your advisor, your portfolio would be split between metals and power, and power is something that we've raised increasingly across this whole year. At the beginning of this year, we were heavily invested into metals. It was a proper tilt towards metals. Now you would see an even distribution between power and metals, and that is where we want to be right now. And in power, what we are doing is we're not buying utilities like the companies which trade power in the sense which supply power to your home, where a company that name comes up on your bill. We don't want to do that. We think that we are very early in the cycle, and why we don't want to do that? Obviously, sure, they'll make money. They continue as in because of climate effect and because of power shortages as well. You would continue to consume more electricity. So obviously, their revenues will keep going up. But this is not the time to be there. They would give you returns, but it would be at a lower scale. We are in the power sector. We are in a build phase. So whenever you are in a build phase, you're increasing the number of lines, or think of it as a road. So the road currently is a 2-laner. You want to make it a 4-laner, and at the end of the road there is a toll booth. So when you are at 2 lanes, your toll booth kind of has just 2 lanes to do on. We think this 2-laner is going to become a 4-laner. So the idea is to invest into those road building companies. You're not investing into road building companies. It's just an analog, basically, that the 2-laner is going to become 4-laner in your power sector. So we are investing into companies that basically build those power lines for you. Grid capacitors, basically somebody who can deliver or through their network, power can come to your home. So that is where we kind of heading into. This has been our hunting ground: energy, materials, industrials, power, and the grid. Autos and fertilizers we are very selective on. Thankfully, we've been able to deliver in auto scheme as well, and fertilizers have also done well for us. Particularly in fertilizers, we avoided the urea players and we went through phosphorus and other players as well. That was a interesting play which came around because green ammonia signing, which happened I think in April, unlocked the input cost as well there. The other sectors that we kind of are looking at, defense we've been overweight. Capital markets is something very interesting. While we are kind of neutral on private banks, I think public banks also we've taken out after we've had a good run in that. We started looking at capital markets because this 9 to 15 month window in equities gives suppliers of capital markets again the same road scenario. Here, the kind of the road is kind of built. You have everything possible. So basically, the eventually that toll booth kind of ends up making a lot more money. So investing into that toll booth makes a lot more sense than um, investing into a road building machine. This is from the capital markets side. In pharma, we have started becoming very selective, and we started looking at it much more. We're not looking at defense. And what pharma does for us is basically it adds a little more defensiveness into the name or the whole portfolio. Given that we've moved, we've always been a little heavy on cyclicals to reduce the volatility we are adding onto pharma name, because that has also started looking well for us. And similar, and if we are looking at pharma, it makes sense to look at specialty chemicals as well, especially in your commodity and your CDMO space. Um, Two calls that which aren't India, then we continue to be overweight there is basically China and silver. Reasons being the same. We want to be in emerging markets and we want to hedge to inflation. We can always hedge it through gold as well, but if you want to increase your risk as well, then you can add up to silver. Given that we are reducing risk on the equity side, we are happy taking risk on the hedge side. And eventually, at this stage, what I want to say is that what this regime means for India is that it is a tax on the index. So if you think that you want to just buy an ETF kind of which kind of gives you X amount of returns every year, then that's probably not the best way to play this. This is a gift to the right sector. This higher inflation regime is a gift to a certain number of sectors. So it's basically someone would come and tell you that this is the stock pickers market, because some sectors will do really well, and overall the index will kind of lag behind as well. So that's what we kind of seeing around, and that's how our executions are being done. Equity through our different risk profile, we've placed ourselves this way. We are not very positive in keeping debt. The reason being the same, that as inflation goes up, you don't want to be in a fixed pair market. You want to have something which is floating. Debt time will come obviously when equities start lagging behind. Once your interest rate starts going up, equities would go down. Sorry, and that's not exactly the time to move to debt. There are other instruments also that one can move into, but debt time will come again. And in a world which is trying to become inflationary, we don't think debt should be the place to be. And similarly, our hedges of gold and silver, we've not kept any cash at this point of time. We'll look at when we again, cash for us is kind of something which keeps switching between drag and a night. We've never thought cash to be king, at least in this particular thing. So right now for us it is a drag, but we can move to it to very very tactically. We can kind of move to cash for a very short period of time as well, and that is what the market kind of is. In a very choppy market, that is how kind of we can build on to alpha. Uh, I think this is what breaks the thesis and the hedge. Basically, we're looking at how many ships are kind of moving through Hormuz. That tells us that where we are in the war. Honestly, I don't think even the leaders know where they are in the war. So what we are looking at is somebody's been very kind enough to build a Hormuz tracker using Claude, and they've just put it up on the web to see for everyone. So that's an amazing site to visit. So what we do is that we kind of keep looking at the Hormuz tracker and see how many ships are passing through, and that tells us where we are in the war. The ceasefire similarly is the opposite of it. The more number of ships passing through, that will tell us whether how much premium should be lost. Keeping a very strong eye on WPI as well. As I said, the recent reading of 9.5%. We expect it to maybe just soften a bit and then rise up. We will always look at RBI and when they want to hike rates, and all of this breaks if your inflation starts coming down. And if inflation were to come down, it won't be a very happy scenario. So we don't really want this case at this point of time, because overall, even though the world is kind of placed there, lower inflation at this particular point of time would mean something very bad has happened, and we don't want to be there. This was our June. Last month we were here. We kind of keep doing this just for people are getting a little tense around where the markets are. So this is the last time around we were here at that point of time, I think around 23,000 odd. And if you remember, what we said was that we wanted it to move. We had this supply zone. We thought it would not hold and we would ride through. So why we were kind of long here was because there was a very strong demand zone at the bottom here. And we thought we'd kind of go up, and hence we were entirely, that's when we might catch 0% in the portfolio. So from there, where we have gone is, obviously we were here. Now we moved to this. So we moved to this supply zone, and the idea was that we would ride through this supply zone. The supply zone has taken kind of a long time to kind of take out. It's different than what we had thought internally as well. The idea was that this would kind of, we could ride it through very, very smoothly. Even if you remember last time around, the other factor that we said, that if it takes time in the supply zone, then you should be able to see another supply zone kind of appear right in the middle here somewhere, and that is where I think we could end up. So but this move is very important. This up move is very important because it changes the structure of the whole bull market. At this point of time, there are naysayers, or there are the people in particular dilemma that whether this is a good market or not. What this particular up move and being even if it stops here and comes down, this particular move will eventually do something which is called, which will validate something which is called the Dow theory. So this is the particular previous high. This is a particular swing high. Until and unless we take this out, it becomes very difficult for somebody to confirm that whether we are in a bull market or not, or whether this is a market that is going to move up or not. Bull market is too early to be saying whether this market is going to go up or not. So this, taking out this last swing high, becomes very important. And hence, even if we get supply and probably come down, it would confirm a number of things for us, in our allocation itself. One good part is that your floor again here has shifted. We've said this in inflation as well. If your floor kind of starts shifting up, it is always a good thing. So in any stage, if the market were to fall below this, then it would mean that we are not in a rising market. So the best part about this is that your risk now becomes from your 24,325 where we are, I think somewhere around 24,270 is where we are. I think 23,200, which is like a 5% risk. You've got you can kind of be invested in that manner. So, and in no stage should your latest swing low should be taken down. If this happens here, then we are kind of heading much lower in that stage. So it becomes a very, very simpler. This is becoming a much more simpler structure, even though it looks complex. We're moving into a very simpler structure now. Because you've started to have these levels wherein which you can call it that whether we're moving higher or lower. Again, this is our track record. Across time, we've faced different phases. We've kind of delivered in that regard. What it means that what you can do, we've created this particular platform where you can come and do a portfolio health check. You can also create a personalized allocation for your goals as well, or schedule a clarity call with us as well. So that we open for. You've got 3 different ways of reaching out to us, and happy to take that. A few questions that we kind of got, and I'll just come back to that. Just taking, we've been able to finish right almost on time, like almost 2 minutes over time, but that's fine. I think I'll just take the questions first that we got on our form, and then we can move to questions in the room as well. So these are the questions. I think there are new questions as well. We'll take them as well. What's next for the Indian economy? Where do you think growth is coming? Which sectors continue to be undervalued? In terms of undervaluation, I think one of the most common undervalued sectors right now, a lot of people do think, is around IT. I'm still not being able to kind of wrap my head around. We found out one play. It's a slightly expensive play in terms of expensive play, as in it's slightly a bigger play. The market, the valuation of the company, the market cap of the company is of the nearly around 1 lakh crores. So that we don't really want to we're looking for different names in that particular thing. We've not been able to finalize the name yet. That comes from the fact that we're not getting enough conviction around IT as a very undervalued sector. We may get convinced given how particular companies kind of roll out their particular AI themes, but we will look at it. Other undervaluation, I think, yeah, wherever we are kind of overweight in that, we think they are undervalued. That is why we are overweight. So again, energy, metals, infrastructure, power, defense, pharma, auto, reality, and capital markets. I think wherever we are kind of overweight, I think we are overweight because we think those are undervalued. Is the AI boom structural and right now just needs valuation and readjustment? Well, we've got these two slides again, apart from the 1999 to 1997, to 2026 kind of overlay. Very quickly, S&P earnings are kind of popping up, which is good. So earnings are real. First and foremost thing of a bubble is that whether earnings are real or not. Earnings at least right now are real. So that's one good thing out there. And actually, if you kind of look out, this is your change in market cap since in S&P since the beginning of this year. Except for energy and AI, if you were to strip those two out, the remaining of the sectors have kind of a negative market cap, and all the returns have come through returns in either the energy sector or the AI sector. That tells you that kind of we are at all of that could have been priced in as well. So again, in terms of valuation, what we feel is that the forward PE for the particular index, it was here. The 10-year average is around 19 times. We are at 20 times, so it's not undervalued for sure. So I think that's there. This is a major problem that I think one should look at, and we are continuously looking at, is basically your free cash flows are not being generated. So whenever I'm doing business, my biggest reason to do this is that I'm at the end of the day, I should get money, right? So if I'm not getting cash, then I can have a lot of earnings, but I'll not be able to sustain that particular business as well. So the idea, the reason or the problem here is that the free cash flows are kind of not coming through for hyperscalers as well, and we know the reason here basically. So if you look at this, that you've moved into a circular economy where basically Nvidia kind of funds OpenAI, who buys Nvidia chips again. So you moved into this entire circular economy. This whenever I look at this particular image, it reminds me of something like a 2013, if you know, Euro debt crisis, that Germany gave money to Spain, who gave money to Italy, who gave money to Greece, and then eventually there are two outcomes, two ways this gets resolved. One, that somebody at the end of the day says that I don't have money to pay you, or you slowly build, which is a very common story in investment. This is the traveler story in Kenya. So a traveler went to a hotel in Kenya and said that he wanted to see the room. So the manager over there said that yeah, sure, but we take $100 deposit first, and then you can see the room. So he said, okay, no problem. Here's your $100. Now I'll go and see the room. They took the manager took the $100. He went and paid the $100 to the grocery store where he owed 100 rupees. The grocery store then went and put 100 rupees to somebody else who owed him money, and then eventually the person also owned the car dealer or someone $100, who came and paid him back. And in the meanwhile, the traveler came back and said that I didn't like the room and give me back my $100. He could give him back the $100 as well. So eventually what happened, that everyone debts got cleared, and there was actually no transaction, or there's nothing that has happened eventually. But because an inflow of liquidity came through, everyone debts got cleared. So that's another way to clear this kind of a mess, or someone blows up and says that I don't have money, then this whole structure comes down. So these are two ways to solve this. Not happening tomorrow, don't worry. Can happen in a few years down the line, but we'll see what shape and size does that kind of solution takes. Another question that I think we have is basically on FII is not returning in spite of oil cooling off. I think FII is I started selling India long back. It's not because of war that FII. We just kind of started looking at FII because the news channel started talking a lot more about FIIs. They pulled out a large amount of money beginning this year, but they've been selling since almost last 2 3 years. So oil cooling off or going up or coming down, I don't think FIIs will come in India at this point of time. I think foreign investors are looking at a whole different pasture altogether. They're not looking at a pasture which will, if they're placing themselves for a disinflation trade. If that does not arrive, we become a very attractive place to in terms of valuation and wise as well. We become a very attractive place for them. So it's a hedged bet at this point of time. The so-called anti-AI trade, we continue to remain that. We are building our AI capabilities, but we're still nowhere close to what others have built on to that. In terms of oil, again, we this is the kind of tracker someone's actually made on Claude and put it out for people to see. This is a much more simpler version. Over there is just numbers. So what we've done is we've ingested the numbers ourselves and figured out that we can kind of based on how many ships are passing through Hormuz, we can figure out whether the war will have any material impact on the market or not. And the idea is that generally the number of ships that should pass through this rate at this point of time should be around 60 odd. What the number of passing right now are around 15 to 25 a day. It's still not cleared out, and that means that for oil to cool off so much, we're still kind of liking upstream names that they're still there in your portfolio. Oil exploration. Apart from that, even if Hormuz gets resolved tomorrow itself, we believe that countries have figured out that oil is a very high risk area, and until and unless there are again two ways to switch this. Either you entirely move to your renewable energies, or you kind of or you kind of explore oil yourself and build that capability to kind of produce oil yourself, so that risk kind of comes down. I think the questions, at least, there were another few questions below that. Just give me a second. Share the screen. Yeah, so we got a few questions from another medium as well. So if money printing is going on, commodity prices should increase, right? We placed ourselves for that. I think it should. It can take time. It cannot. It shouldn't. I don't know if it happens tomorrow or not. I honestly don't know. But given, let's say, if you were to ask me whether 5 months, 6 months down the line, whether prices of commodities should be higher, they should be. Who is bearing these war expenses? Very interesting question. People like you and me are bearing the war expenses. Nobody else bears any other expenses in the world eventually. US has printed a lot of money to bear the war expenses. Their liquidity has gone up, but that should come out in either in terms of higher oil taxes or other taxes as well. Local market is expecting 10% lower in commodities and equity market from current level before start of the bull cycle. So 10% below would basically mean that you're testing out these regions. Even if it does is a very strong demand zone. My idea is that this recent swing low should not be broken. If this is broken, and then this becomes a very interesting place to be. We'll see when we are here. Right now I don't think that this swing low should get taken out again. Very difficult to say. If it were to come down 10%, it would not come down on a very calm day. There has to be something right which has to pop up for it to come down. There are a number of factors that are taking place right now, but they're very early in the stage. We'll kind of get there would be, if you're looking at a number of markets, then there would be an indication somewhere which tells us that probably things have moved forward in geopolitics where we are at this point of time. What difference is it to be done to get more than 16% of return compared to normal rate of return? 16% more than normal rate of return. That would be a very weird place to be. If your normal rate to return, return is around 12 to 13%. That's what Nifty is given. If you were expecting 16% more than 12, 13%, it's very difficult. If 16% is your target, uh, again, I'll kind of tell you what Warren Buffett says. Warren Buffett says that the idea of a happy marriage is kind of having a low expectation. That's what I believe, that if you marry to the market, have low expectations. If it delivers more than that, it just makes you happy. Going into the market with 28% kind of return targets is just possible ways of getting disappointed. You may end up getting more than 28%. You may, but having that expectation and not delivering leads to a lot of disappointment, rather than having an expectation of around 12-13% and then delivering around somewhat better. Gives you kind of solutions to increase savings. Uh, See, there are a number of ways that, and this is a very interesting factor that one can tell you. So right now, where US is going through, US has a lot of debt. Again, as I said, that is just a number right now. Now 38, 39 trillion or 45 trillion or 50 trillion. How does it matter, right, anymore? So it's just a lot of debt. So two ways that you can clear out that debt or increase your earning. One is increase your revenues in some way or the other, and the second, only available, I think, to central banks, is then either you can debase the way that you can kind of you measure your expenditures. In that format, I think for common you and me, I think for common people that does not apply, but for countries, I think that is applicable. So countries could end up doing that. You and me, to increase savings, I think only one way, two ways exist. Either you cut your expenditures or you increase your earnings. These are just the two ways to increase your savings, because savings is basically income minus expenditure. So in simple ways, either you bring down your expenditure or you increase your earnings. That's the only way to kind of increase your savings. That's a very simple mathematical equation. I think apart from that, I think we're done with questions. I'll just look at the online thing again for any other question that may have come up, and then move to questions on the. So there is this set of questions. Which would be the new next blue chip winner, and which sectors would drive the next bull run? I think where I've kind of answered that wherever I think we placed ourselves, I think these are good places to be in. Which is the next blue chip out of that? Well, for this, I think this particular regime itself is very interesting. I think this regime itself is a tax on the index. For the index, it's a tax. For the right sectors, it's a gift. Again, if we have to increase beta, so okay, this is how we've kind of placed ourselves. So in this reflationary world, I think we are adding risk by having mid and small cap. So that's one place. That's the idea that we are kind of doing. In terms of blue chips, again, very difficult to tell you that which exactly blue chip will be a winner. But the sector that we are kind of placed in terms of what's your view in the market in the upcoming 5 odd months? I think we've told you the range that we are looking at. Is AI structure? We've gone through this. So I think it's structural at this point of time. Valuation wise, you are right that it needs some bit of readjustment. And where would you invest to increase the returns? Or we are happy to take risk through mid and small caps. And what's the outlook for Indian IT revenue deflation? I don't think we should see a revenue deflation kind of a thing. It would be difficult because AI still is in a building phase, so we don't expect that. I think whatever we had to suffer, we've done it because we were a service-led kind of IT sector. We've kind of moved. The IT companies themselves are adding agents and other ways to kind of serve their own clients as well. So I think we should revenue at least should not devalue. If anything, your spend on your AI could go up and could lead to profit devaluation, but not revenue devaluation is what could come around again. Happy to take any questions that come up. On our chat.
Hi, Karan. I have shared on chat box one question.
Sure. I just checked now. Thank you so much. Right now, as in NRI, if you're getting 14 to 15%, return by leveraging on FCNR, is it better than market returns? Uh, so yeah, so basically the question is basically that as in another, if you're getting more than getting around 14 to 15% per annum dollar returns by leveraging on FCNR, uh, is it better than a market return? Uh, and then there is a question which again correlates to it, is which is what is our view on the effect of INR depreciation? Okay, so these two I'll take together. If you first and foremost in a world which is moving into, and the number of times that I've said this word today, I think should be a record somewhere, is that if you're moving to an inflationary world, we don't want to be placed into bonds and fixed returns. You're leveraging on top of it. Uh, Interesting play. It leads to a higher risk than what it surfaces on the paper itself. Uh, I think with that, yeah, if that the value of your paper, if it starts coming down, um, depends on the covenants of the paper itself. But if your value of the paper comes down, I think that margin calls will be difficult to meet. I don't expect, again, we'll have to take a look at the covenants as well. So happy to take this outside as well. We'll go through the paper itself and see what is in place, and then can give you a better answer. In terms of an INR depreciation, I think I okay. This is something that we did last time around as well, and I think it's very important. I believe that the INR story is kind of overblown. I don't think our currency is that bad, and I'll tell you why. Again, this is not a very popular. I know it's not a popular thing. Not everyone wants to hear this. I don't know why, but I think if you look at, I think you guys can see the chart, right? Okay. If we do this, so this is INR. Right. Okay. Oh, okay. The markings are also there from the last discussion that we had on the call, but and I'm happy to take them again because it's a very interesting question that comes up almost every time. So right now INR is at 95.2, and the problem is that since I think beginning of or mid of last year, you've seen this sharp drawdown from 83 to 95. This is what gets everyone worried and think that INR is like a very weak currency. Now, how much should INR depreciate by is the question that one should answer, right? So INR should depreciate by the difference in the interest rates between two countries. So difference between the US interest rates and difference between the Indian interest rates is the interest rate differential that interest rate differential is how much your rupee should depreciate. Generally, ideally, this difference between the US yield and the Indian yield has been around 4 to 5%. Very recently, the difference between these two have become 2.5-3%, right? So if you look at it right now as well, the 10-year is around US 10-year is around 4.5, Indian 10-year is around 7 odd. Where are we on Indian? You will just quickly bring that out as well. IN 10-year. Okay, so IN 10-year is at 6.7, right? So 6.7 and 4.3, 4.4. Your difference is around 2.3. But this is a very recent phenomenon. If you were to make this as well, if we bring this out, okay, we can do this. So IN 10-year minus your US 10-year. And this should basically give you your differential of, I think this is it. Okay. So this has been the stage. Now over time, if this is a daily chart, if I were to bring this to a monthly chart, we could see a long-term view as well. So long-term view is basically that this particular differential has been between 4 to almost 7 odd percent. So this is how much rupee should depreciate. This has become kind of a very very tight after 2023, that our interest rates have been much better than US interest rates. US went through this demonic rate hike cycle, which was in 2022. And if that was demonic, I think the upcoming one could be really good as well. In terms of that, 4.5, 4 to 6% is what generally is the rupee should depreciate by. Now, right now, it should depreciate by around 2.2%. If you take almost an average, 3% should be a ideal average around what rupee should have depreciated by. And we go back to the rupee chart. INR, USD INR, okay, USD INR, yes. So this became a monthly chart. I'll just make it into a daily chart. So if we look at it, today rupee INR is USD INR is in 95.2. And this is over the last 6 years since your COVID times. It should have, let's say we can discount this. So this is divided by 1 plus around 3% and for a period of 6 years. So during your COVID time, if your rupee was around at 70, 78, 79 odd, you are at a great place right now. So taking it from a long-term perspective. So during COVID times around, you were at around 75, 77. So you are almost there, right? What has happened is that during this particular one period in our whole journey, between 2022 to 2025, then Governor Shaktikanta Das thought that it would be a good idea to manage the rupee through issuance of other things. So rupee was kind of managed in a very small tight cycle as between 79 to 80. And this particular period, and if you remember, this is October 2024. This is exactly when we had a lot of people tell us that rupee rupee is the best performing asset or currency in emerging markets, and a lot of people started investing into equity. So, and this is probably the top of kind of the equity market as well. So around September or October 2024. Right now, and then we had a change in governor, and the new governor thinks that the market should decide the price of USD INR. So on that regard, the market has decided that we will depreciate by 3.2% or, and this is how Indian rupee should depreciate. So I don't know whether Indian rupee is weak or has depreciated enough, or we've pretty fair value. Okay, so I'm not of a belief that Indian rupee is at a weaker currency. The problem with this is that now the news is absolutely opposite to what was there in September 2024, that we are the weakest currency, and that would entice you not to buy equities or to sell equities. I think we are at a very okay place. We've not done enough. We're not doing very good. So yeah, that's the view that I kind of hold on this. One more question that we've got is that observation: are you weighing the impact of El Nino on the economy? The effects are apparently real, but I don't see it being priced in or discussed enough, or have they? Okay, so the question is on El Nino and the climate effect, and we are looking at it as well, and we kind of our portfolios are positioned in that way as well. Our portfolios are positioned for El Nino in two ways. One is the power cycle, because of the higher climate, higher temperatures in the climate. We think the demand for power is going to go up. So that's one way to play it. The second is obviously the commodity prices. The agri commodities will kind of start feeling a lot of pressure. So things like fertilizers, things like your pure supplier of consumption items like rice, maize, other agri commodities that you kind of think of. So that's something that we're placing ourselves on for. So El Nino, we've kind of we've seen the effects, and we're placing ourselves for that particular thing as well. So that's there. Regarding IT sector, it will go down. It will still go down. What is the bottom for IT? I think very difficult to call the bottom. If on valuation perspective, I think we are fairly valued on, or we slightly undervalued on IT. I see a lot of changes happening in the IT companies, and valuation wise, they started to make a lot more sense to us at least. So that's where we kind of um, we don't think the bottom is. I honestly don't know if the bottom is in or not. But if not, then the downside remains very low. So risk reward wise, I think it's a decent sector to be in. Not the best sector to be in, honestly, because I don't. For the upside, we'll require a massive change in terms of looking at it as a IT as a AI play. So return wise, it might not be that. So risk return ratio, while more than one, may not be the best one out there. So that's our view on IT. Any other questions that I can take on? Cool. If not, I think we got so many questions, and this is the beauty of this particular format and the particular time that we live in. If you've got questions, do reach out to us. We are always available. Your questions make our research interesting as well and better as well in a world which is driven by artificial intelligence. While knowledge is still a power, but that edge is kind of going away. I think becoming more curious is kind of the best place to be, and questions and interactions with almost like questions and interactions with everyone that we've come across have only made our research and our positions in the portfolio better. So always open to having a conversation and discussing as to where we are headed on, and it helps us build alpha for you. So thank you for giving your time. Have a good weekend ahead, and yeah, thank you so much.